Hi, I'm Shiloh Bates, and welcome to the CLO Investor Podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I get to interview key market players.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. The views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates.
Today I'm speaking with Cyrus Moshiri, Head of Structured Credit at New Mountain Capital. We discuss how New Mountain is differentiated from other private credit businesses, if private credit is as attractive as it used to be, the risk in software industry loans, and loan defaults in general. Some housekeeping items. I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. And I recently put out a YouTube video on captive CLO equity funds. Let me know if I'm missing something. And if you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with Cyrus Moshiri. Cyrus, thanks for coming on the podcast.
Thanks, Shiloh. It's a pleasure to be here.
So we always start off with the background of the guest. So how did you end up in the CLO, BDC, private credit space?
I've been at New Mountain Capital for about 5 years now. Prior to New Mountain, I was at Goldman Sachs for my whole career previously. I joined Goldman out of college and actually started my career trading mortgages and structured credit in Tokyo. I was a East Asian languages major and I had a travel bug to go work in Asia. So I went out there immediately after college and a mortgage trading CLO syndicate role. Post-crisis, the CLO market really took off in Asia. And I was sitting in a seat where I was interacting with the Japanese banks, the Korean insurers, Taiwanese insurers, as they were all coming back online and really helping the CLO market reopen. In 2014, I decided to focus full-time on the CLO space and moved back to New York to join the CLO banking desk at Goldman, but still maintained my responsibilities for working with our Asian investors. That's been a big part of my career, and that's how I got into the CLO space.
And what was interesting to you about the opportunity you saw at New Mountain?
New Mountain, where we are today, we're a $60 billion alternative investment manager. We were maybe half that size when I joined. What was really exciting to me about New Mountain was the quality of the platform and the firm that Steve and our partners here have built over the past 25 years versus other asset management shops that go into new spaces with a goal of just accumulating assets. New Mountain has a really thoughtful and long-term approach to entering businesses and commitment to business lines and building business lines when there are ups and downs as one tries to build a new business, and the same commitment to people. I'd spent over a decade at Goldman and didn't want to move around, so I thought New Mountain would be a great place for the foreseeable time frame. It's going great here, and it's played out even better than I would have expected.
Is your industry expertise where you focus more on software, healthcare, non-capital intensive businesses? Is that what you think is the biggest differentiator for New Mountain?
The biggest differentiator for New Mountain isn't saying that we are a sector expert in this specific sector and will be forevermore. The way that we think about approaching sectors from the ground up, we call that defensive growth investing. What we do is every year we re-underwrite the sectors of the economy that we think have acyclical growth trajectories, can grow despite macroeconomic headwinds, really that are great compounders despite any volatility that can occur in the broader macro economy. That have flexible cost structures and really a host of other positive credit characteristics. Then we stand up really deep diligence efforts across both our private equity side and our private credit side. And these efforts are fully resourced with investment professionals, expert networks, executives that we bring onto the masthead. So we're bringing a level of resources that a standard credit shop can't bring to bear when analyzing direct lending loans or broadly syndicated loans. I would summarize that by saying it's not just a specific niche of expertise that I think differentiates New Mountain, but it's the way that we go about building that expertise. And constantly we underwrite these sectors. That is what's differentiated us over the past 25 plus years.
In a lot of cases, I take it, on the credit side, you're evaluating a loan opportunity where New Mountain is not the private equity firm that's buying the company, but it's another private equity firm, but maybe New Mountain looked at acquiring that same business in an auction process. So you're able to use that due diligence that's already been done in-house to inform your credit analysis.
That's exactly right, and is a really great case study of what makes our credit business different. It's the collaboration between our credit side and our private equity side, where we've done a lot of work diligencing companies, see 1,000 companies a year on the private equity side, and through varying stages of diligence. It can range all the way from simply reviewing a SIM all the way to having bid on the company in an auction process. That leads us to be better lenders. We know these sectors better. We know the specific companies in our niches really well. That helps us pick the good ones. It's really proven out well.
So then in credit, you guys have broadly syndicated CLOs and BDCs. What's the overview of the different products you guys are managing?
Our credit business is around $15 billion today. Roughly 25% or a third is in broadly syndicated loans, predominantly via CLOs. And then the remainder is in direct lending. We have a host of vehicles for that, our largest being NMFC, our publicly traded BDC.
So in the industry, the general trend has been to oversubscribed tenders, and these stories are really front page news, which maybe surprises me a little bit. How do you guys think about oversubscribed tenders? What's kind of driving it? And is there any expectation for a change later this year? Or how do you see it?
So fortunately for us, our latest tender was not oversubscribed. It's below 5%. So we feel great that our investors want to stay invested with us. But speaking more broadly for the market, I think it's just an inevitable symptom of the exponential growth that we've seen in the space. And that combined with credit jitters, potentially the start of a real credit cycle that we haven't seen in a while, combined with a meaningful pace of headlines, negative headlines on the private credit industry, some degree of opacity as well for investors where these BDCs are their first foray to private credit. So I think it's sort of a perfect storm where there's a prisoner's dilemma of sorts where investors say, you know what, I'm feeling shaky here. I need to get out. There's some sign that maybe in the back half of this year, this abates to some degree. But I think for the next couple of quarters, redemptions will still continue to be under pressure, just given the degree to which some of the larger complexes, their tenders were meaningfully oversubscribed.
What are they doing with the money that comes back via tenders? Are they buying investment grade bonds, high yield bonds? Is there some other asset class that private credit is now competing with, or mind share, or how do you see it?
It's an interesting question, and I don't have real great data to back this up, but a few anecdotal data points are, I have heard about increased interest in public bond funds. I have heard about a number of sophisticated RIAs simply rotating from private credit funds, like the vehicles that we just discussed with the 5% tender option, into public BDCs because the stocks are trading at a very meaningful discount to book value, not really exiting private credit, but expressing a view on relative value. I don't think that that is at all the majority or maybe even a meaningful amount of the rotation, but it certainly was an interesting anecdote to hear about, and I think a thoughtful approach from a long-term asset allocation perspective.
So I was recently at the Credit Flux conference in London, and I would say sitting through the panels, I mean, it's hard to even attend a panel where software loan risks didn't kind of dominate the discussion. So very interested in your take here just because of the expertise that New Mountain brings to software investing.
We think that there are going to be winners and losers in software. To summarize it at a high level, software businesses that are purely analytical, that have per seat user licenses, and really don't own the underlying data, we think are a key risk for AI disruption. Somebody could easily use Claude Code or other similar tools to build those themselves. But on the other hand, software that serves a very specific vertical niche of the economy that has a really rich data ecosystem where companies rely on that software for essential business activities such as payroll and other compliance or regulatory related activity. We actually think those businesses are well insulated. We're increasingly seeing in the public loan market pricing bifurcate based on the style of software business that I just described. We definitely think there's risk in the software space, broadly speaking, but to wholly write off the software space is premature. And that's our view at a high level.
So for the software loans that were made prior to this year, what do you think kind of the starting loan to value would have been?
In our book, roughly the LTV on our software loans was 25 to 30 and change percent. We had a meaningful amount of equity cushion beneath us. Even if one believes the public market sell-off and assumes a similar trajectory for these private businesses, irrespective of the niches in which they operate and the characteristics that I brought up, even with a 30% or even 50% degradation in equity value, the loans are still covered. It's a very bad day for a lot of the private equity firms that have sponsored these businesses. But from a lender standpoint, we still feel well covered. That being said, immediately following the release of ChatGPT, we stood up a firm-wide effort to really understand the potential impacts of AI, again, bringing external experts around the table with us, and have underwritten the vast majority of our software exposure in a post-ChatGPT world. We feel very good about how our software is positioned more broadly. And really, when underwriting our software, think about the end industry niche where it's operating and how essential that piece of software is in the daily workflow of those businesses. That's a key defensive characteristic that has always been in our underwriting mentality around software. It's really playing out well in terms of how businesses with those characteristics will end up being defensive and resilient to disruption from AI over the next few years.
So recently I was on a panel and I was asked, as an investor in both broadly syndicated CLOs and private credit CLOs, if I felt like software in one or the other would outperform or underperform. Do you have a perspective on that?
My initial reaction to that is that I think software and private credit CLOs or direct lending more broadly will outperform. A key characteristic of the broadly syndicated loan market is the need for ratings from one of the big three rating agencies. And up until very recently, the rating agencies really struggled with large software businesses, irrespective of the quality of the ARR and the niches in which the business operated, the data that the businesses owned, all of that. It was really kind of a broad, old economy style approach to rating software loans. My assessment would be that broadly syndicated loan market, this is at a very high level, likely was adversely selected versus the private credit CLO market or the direct lending market in terms of quality of businesses that were able to extract capital from those markets and borrow from those markets. So I would think that the performance of software loans and direct lending is going to vastly outperform that of the BSL market. I would also add that from a documentation perspective, it's likely that the documentation in broadly syndicated software loans is weaker than that of direct lending loans. To the extent that we see these companies get into trouble, there's a higher likelihood that there's lender on lender violence in the broadly syndicated loan market versus the direct lending market, which will ultimately lead to higher recoveries for any defaulted loans in the direct lending market. It's an interesting question, and I think it hits at the heart of what a CLO equity investor should care about. It's what are my defaults going to be and what are my recoveries going to be on an underlying loan? The direct lending market, although there's a higher percentage of software, broadly speaking, in the direct lending market, likely has done a better job of lending in software than the broadly syndicated loan market, I would say.
So I gave a similar answer, but two of the things that broadly syndicated loans would have going for them is, on the one hand, the borrowing costs are going to be much lower. So you're talking about SOFR plus 3% for a BSL software versus maybe SOFR plus, call it 5 for private credit. So just less of an interest burden. And then the company size in BSL, you're going to find companies with 100 million of EBITDA or more. You think, in spite of those two benefits for BSL, you still think private credit is going to outperform here for software loans?
I think you need to equalize for size, and you can definitely do that because so much of the large cap lending that occurred in the direct lending space was to the software sector. Apples to apples, similar sized software company, I think will outperform in the direct lending market. I think the interest burden issue that you highlight is a real one, but at that point, when we're talking about interest burdens of that amount, we're really seeing a business that's teetering already. It's less about the quality of the business. I think when we think about investing in credit, we want to invest in businesses that never reach that point. If we're already talking about, well, is this going to be able to service its debt? I think you're going to be having that issue, whether it's in the direct lending market or in the broadly syndicated market.
Software loans, especially the traded ones, for businesses that came into the year with loans marked around par, those loans today maybe clustered around a $90 price or so. I mean, is that potentially an interesting place for you guys to add, or are you being more defensive?
Definitely. I think they're, again, like within very specific niches, there's businesses that we really like in the software space that, again, have extremely rich ownership of the data, are essential in the end user's daily operations, and that have regulatorily mandated need to exist. We love businesses like that, and we think they're going to be around, and we think they could even be enhanced by AI. We are selectively looking at adding opportunistically the space as well.
So then one of the things that was a real challenge for CLO equity investors last year, 2025, was just the elevated, people always say default rate, but it's really the loss rate. You need to factor in the recovery rate. And so then this year, I think a lot of people kind of came into the year being pretty optimistic that default rates would come down. I think maybe part of that was the expectation for SOFR to decline, which is no longer really the expectation. Is it your view, kind of X software, that loan loss rates should be coming in this year, or would you expect it to be another elevated year where we're still working through some of the excesses of the 2021 loan vintage?
I wish I had a different view, but I do think we're going to be sorting through this for the next year. The underlying factor of elevated base rates plus macroeconomic stresses that really get to flow through. You're seeing some of the disruption and impacts from AI, but also for the US consumer more broadly from the war in Iran. And you get to see how that is going to play out. So I think there's a lot of macro uncertainty where it's biased in the downside for a lot of highly levered borrowers.
So would you say, though, that it's for software, if there are some losers, as you say, are those losers for 2026 or are those future defaults? And we're going to be elevated defaults this year just based, not even factoring in software?
For software specifically, I think there are future defaults just given these businesses still have immense ARR bases. And although they are, some are deteriorating, they're not deteriorating as rapidly to the extent that it's a near-term problem. I think we're going to need to see meaningfully more AI adoption for it to be a very broad issue this year in the software space. There, of course, are going to be businesses in software that have meaningful issues that came into this with over-levered capital structures. The marginal impacts of AI tip them over the edge. I don't think that is the main narrative. We are going to see a deterioration of lower quality software businesses over time, and that's going to take 12 months, give or take. It's an area that we as investors need to be monitoring closely, and it's going to change the credit landscape both in the near term. More broadly than software, just in terms of the geopolitical events that are occurring in the Middle East, we've yet to see that flow through into U.S. economic numbers, sure to the reaction of the U.S. consumer. It's been a long time since the U.S. consumers have lived with rates this high. And we're seeing the impact on personal balance sheets. We're seeing the impact in numbers as it relates to car loan delinquencies and the amount of balances that folks have in that space. So it's going to be a complicated situation. And I think we're going to see a continued exacerbation of a K-shaped economic narrative in the United States to the extent that the war in Iran continues and we see elevated oil prices and gasoline prices in the near and medium term.
Is your view that the fundamental challenge our industry is dealing with is just that there's just too much demand for loans and not enough creation via LBOs? So that results in loan spreads that are too tight, maybe some businesses with too much leverage and loan documentation that's more favorable to the private equity firm. I mean, is that kind of the underlying driver of the poor, at least performance for CLO equity over the last year and a half?
That's an interesting question. I think that's certainly part of it. When we think about the growth of the CLO market, it led to a massive inflow of capital into the space globally from banks, insurance companies, pensions, and more broadly endowments, high net worth individuals on the equity side, led to a meaningful loan demand. I'd say same thing on the direct lending side. The amount of capital that's flowed into the space over a similar time frame has meaningfully repriced the market. Baseline spreads on unitranche direct lending loans used to be S plus 600. Now they're either side of S plus 500. And that's potentially a secular change to some degree. I think we're going to see that normalize in a meaningful way because of the outflows that we're seeing from the perpetual non-traded BDCs, which I think is healthy for the market to reset a bit like this. And it likely means that the investment landscape for the next 12 or 18 months is actually going to be very attractive for long-term oriented credit investors. Levered credit cycles like this, there's default spikes, there's outflows, that's when it's a really attractive time to accumulate assets. From a CLO standpoint, the arbitrage might not be screaming at that point in time. Given the optionality that you hold as a CLO equity investor, the ability to reset those liabilities in a year or two, or three, if that's the optimal point in time, can create meaningful value for your investors that's not locked in day one, but that you have over a long-term investment horizon. So personally, I'm quite bullish on the prospect of vehicles that are newly formed and ramping over the next 12 or 18 months.
So on a platform like yours, where you offer both exposure or investments in broadly syndicated loans and private credit, do investors come to you with their stated preference in mind and you then guide them to the right product? Or do you have some house view that BSL is more interesting than private credit or vice versa? How do the investors get sorted into your funds?
The investors usually come with their mind made up, frankly. Given the broader volatility in credit over the past few weeks and months, we have had increasing conversations with investors about developing slightly broader, more separately managed account style mandates across the breadth of our credit and yield-oriented products, which we're really excited about. We love partnering with investors over the long term across products because at different points in time, BSL might be more attractive than direct lending or vice versa. So we love the ability to be tactical for our clients in that way.
So then for an equity investor, either again in BSL or private credit, a big driver, the biggest driver will be the performance of loans and loan losses. But a secondary, very important factor will just be the financing costs, right? So all the portfolios of loans, for the most part, are going to be levered. The terms and the spreads that you pay are quite important. So how do you think about that? And what's your strategy for getting the best debt execution for your funds that you can?
We view our debt investors as investors with New Mountain, just like the investors in the equity of our CLOs as well. And it's really important to us to form long-term partnership with our lenders, the debt investors in our CLOs, the lenders in our ABLs, to give them regular updates on the market, how we're managing the vehicles, and engage with them as actively and in a high quality and transparent way. We've been doing that for many years. It's through that that we've built really long-term, high-quality financing partnerships. When it really plays out is availability of financing in difficult times, as opposed to the marginal basis point. So 1 basis point or 2 basis points on a tranche, that matters for sure. When we think about it from a platform perspective, we want to be able to finance our vehicles in any state of the world. There's inherently a mismatch between assets and liabilities in any of these levered structures. And we need to be cognizant of the risk associated with that. And I think the most prudent thing we can do when managing leverage is making sure that it's always available. And we do that through forming long-term partnerships and being a good partner to our lenders.
So related to that, there have been a few stories in the press about how banks have exposure to software loans by lending to funds like yours. I'm wondering if you think that software loan risk has a potential, maybe not for your investments, but for others, of eating through the equity of these funds and impairing potentially a bank's balance sheet.
We're talking about a very fundamentally different state of the world than when similar things occurred in the financial crisis. The banks and the funds that they lend to just aren't as levered. That is the fundamental point. The typical direct lending fund is running around 1-to-1 leverage, 50% LTV. Even in a extremely draconian state of the world regarding losses, the banks are still in a very good place from a coverage standpoint in terms of their equity cushion. So that contrasts in a very stark way to the lending that banks were doing pre-crisis. The bank balance sheets were much more levered, broadly speaking. Banks were taking full equity risk on a variety of loans, corporate loans, consumer loans, mortgages, and didn't really have equity cushion beneath them. Mm-hmm. We're talking about very fundamentally different states of the world and the resilience of bank balance sheets. I think the bank balance sheets today are in a much, much stronger place, broadly speaking, and then also in regards to the construction of the lending products that they offer borrowers such as ourselves.
Cyrus, is there anything else topical that we haven't touched on?
Look, I think it'd be remiss if we weren't talking about the growth of insurance and what that means for investors in our space. It's a really exciting time as the insurance industry is innovating and developing products to meet the retirement needs of Asian baby boomers. As creators of structured products, we're creating product that ends up feeding those investments. And I think at the end of the day, what we're doing as kind of institutional investors is answering the question of how are we helping? How do we help people retire? Whether that's through defined benefit pension plans, bond-traded PVCs for higher net worth individuals, or through creating structured products that insurance companies buy that ultimately feed annuities. It's been growing quite rapidly. It ties to a point that you made earlier about the insatiable demand for loans that we've seen over the past few years. And I think a lot of it's tied to the growth that we've seen in annuity sales as well. So I think that's something to definitely keep an eye on. And it goes to the point I made earlier about how it's important from our standpoint to be good stewards of capital for both our lenders and our equity investors, because at the end of the day, the products are used in similar ways from different sides of the same coin, creating income products and retirement products for folks across the world.
Good stuff. Cyrus, my closing question is always describe a CLO in 30 seconds.
A CLO is like a little bank. A bank makes loans. You can think of those as the asset side of the CLO. A bank funds itself with deposits, and you can think about those as the liability side of the CLO. The key difference between a bank and a CLO is that on the liability side, depositors take different degrees of risk and are compensated more or less depending on the degree of risk that they take. But at a high level, a CLO looks a lot like a bank. It's lending to a diverse group of U.S. companies. It has a diverse group of investors in the liabilities. Boiling it down to that, that's the core economic activity that we do as CLO issuers and investors. We're lending to companies in the U.S., a lot of which you've heard of, some of which you haven't, but that employ a meaningful amount of Americans and have been a key driver of economic growth for over 25 years. It's an industry I'm happy to be in.
Good stuff. Well, Cyrus, thanks so much for coming on the podcast.
Thanks, Shiloh. It was a pleasure.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any Flatrock Global fund. All statements of opinion or forward-looking statements herein are based on current market conditions and should not be construed as guaranteed as future events, and are subject to change at any time without notice. For definitions of words used in this podcast, please go to flatrockglobal.com/glossary. Risks. CLOs are subject to market fluctuations. Every investment has specific risks, which can significantly increase under unusual market conditions. The structure and guidelines of CLOs can vary deal to deal, so factors such as leverage, portfolio testing, callability, and subordination can all influence risks associated with a particular deal. Third-party risk is counterparties involved: the manager, trustees, custodians, lawyers, accountants, and rating agencies. There may be limited liquidity in the secondary market. CLOs have average lives that are typically shorter than the stated maturity. Tranches can be called early after the non-call period has lapsed. ETFs are subject to market risk, including the potential loss of principal, and may trade at premiums or discounts to NAV. General disclaimer section. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential or actual portfolio changes related to securities of those companies, unless otherwise noted. All discussions are based on US markets and US monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the views of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities, or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice, act as an impartial advisor, or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com. This material is for general information purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any security. TCW, its officers, directors, employees, or clients may have positions in securities or investments mentioned in this publication, which positions may change at any time without notice. While the information and statistical data contained herein are based on sources believed to be reliable, we do not represent that it is accurate and should not be relied on as such, or be the basis for an investment decision. The information contained herein may include preliminary information and/or forward-looking statements. Due to numerous factors, actual events may differ substantially from those presented. TCW assumes no duty to update any forward-looking statements or opinions in this document. Any opinions expressed herein are current only as of the time made and are subject to change without notice. Past performance is no guarantee of future results. All investing involves risk, including the potential loss of principal. Market volatility may significantly impact the value of your investments. Recent tariff announcements may add to this volatility, creating additional economic uncertainty and potentially affecting the value of certain investments. Tariffs can impact various sectors differently, leading to changes in market dynamics and investment performance. Copyright 2026 TCW.